The 4% rule is probably the most repeated piece of retirement advice in personal finance. Withdraw 4% of your portfolio in year 1, adjust for inflation each year, and your money should last 30 years. Simple, clean, easy to remember. There is just one problem. The person who invented it does not use it anymore. William Bengen created the 4% rule in 1994. He spent decades watching the financial planning industry treat his guideline like a commandment carved in stone, and in 2025 he published a book saying the real number is closer to 4.7%, and that many retirees today can safely start even higher than that. Meanwhile, Morningstar, one of the most respected names in investment research, published their 2026 State of Retirement Income Report and landed on 3.9% as the safe starting withdrawal rate for this year, not 4%. And Schwab's research team published findings calling the traditional 4% approach structurally flawed. So you have the rules inventor saying go higher, you have Morningstar saying go lower, and you have Schwab saying the whole fixed rate approach misses the point. If that sounds confusing, it is, and this video is going to make it make sense. If you want more honest retirement breakdowns that tell you what the research actually says, rather than what sounds clean and simple, subscribe and give this a thumbs up. Let's get into it. First, let's understand what the 4% rule actually is, because most people who cite it do not know where it came from or what assumptions it was built on. William Bengen was a financial planner in California in the early 1990s. He looked at historical US market data going all the way back to 1926, through the Great Depression, through World War II, through the stagflation of the 1970s, through every major market crash in modern American history. And he asked one question: what is the highest withdrawal rate that would have survived every single 30-year retirement period in that data without the portfolio running to zero? The answer was 4.15%. He rounded it down to 4% for safety and called it the safe max. The safe maximum withdrawal rate. You take 4% of your portfolio in year 1. Then each subsequent year you take the same dollar amount adjusted upward for inflation. The portfolio stays invested, roughly half in stocks, half in bonds, and the combination of investment returns and disciplined withdrawals keeps the money alive for 30 years. That is the actual rule, not a guarantee, not a law. A historical worst-case calculation based on specific assumptions that made sense in 1994. The problem is that 1994 is not 2026, and the 7 assumptions baked into the original 4% rule have all shifted in ways that matter. Assumption 1. Bond yields were much higher in the 1990s. When Bengen ran his numbers, the 10-year Treasury was paying around 7 to 8%. A 50-50 portfolio of stocks and bonds performed very differently in that environment than a 50-50 portfolio performs today. The bond portion of the portfolio used to provide meaningful returns that buffered stock market volatility. In a lower yield environment, bonds provide less cushion, which means the portfolio has to work harder from the equity side. Assumption 2. The rule was built for a 30-year retirement. If you retire at 65 and live to 95, that is 30 years, the rule fits. But life expectancy has increased significantly since 1994. A healthy 65-year-old today has a reasonable probability of living into their 90s. A couple where both people are 65 has a very high probability that at least one of them lives past 90. And if you retire early at 55 or 60, you might need this money to last 35 or 40 years, not 30. The 4% rule was not designed for 40-year retirements. When you run the historical data for 40-year horizons, the safe withdrawal rate drops meaningfully. Assumption 3. The rule assumes a specific portfolio. Roughly 50% stocks and 50% bonds. Most people do not hold this. Many retirees hold more bonds thinking they are being conservative. Others hold more stocks for growth. Neither portfolio behaves the way the 4% rule was calibrated for. The rule gives you a number without telling you that the number only applies to a very specific portfolio construction. Assumption 4. The 4% rule ignores what is happening around you. It tells you to withdraw the same inflation-adjusted dollar amount every year, regardless of whether the market just fell 30% or just gained 25%. In the real world, this is a problem. Withdrawing $40,000 from a $1 million portfolio is very different from withdrawing $40,000 from a portfolio that just dropped to $700,000. The rule does not care. It says take your number. This is where sequence of returns risk comes in. It is the biggest danger in retirement planning, and the 4% rule addresses it only indirectly through its historical worst-case framing. Sequence of returns risk means that the order in which your returns arrive matters as much as the average return. Two retirees can have the same average return over 30 years and completely different outcomes depending on whether the bad years came early or late. If you retire in a year when the market immediately drops 30%, and you are also pulling $40,000 per year from your $1 million portfolio, you might drop to $660,000 in year one. Now, your $40,000 withdrawal represents not 4% but 6% of your remaining portfolio. The hole deepens. Even if the market fully recovers in years 2 and 3, you are withdrawing from a permanently damaged base. The portfolio may not recover enough to survive another 25 years of withdrawals. The 4% rule survived every historical sequence, including the worst ones. But the S&P 500's CAPE ratio, a measure of how expensive stocks are relative to earnings, is currently sitting at 41.6. That is the second highest reading in history. The only time it was higher was during the dot-com bubble. High CAPE ratios have historically predicted lower future returns over the following decade, which is exactly the period that matters most for someone retiring right now. Assumption 5. The 4% rule does not account for taxes. If your retirement savings are in a traditional 401k or IRA, which is where most Americans have the majority of their retirement money, every dollar you withdraw is taxable as ordinary income. If you are withdrawing $40,000 per year and paying 22% in taxes, your actual purchasing power is significantly less than $40,000. The 4% rule gives you a gross withdrawal number. Your net is meaningfully lower. Assumption 6. The rule does not account for healthcare costs in retirement. Healthcare spending tends to increase significantly in the later years of retirement, exactly when a fixed inflation-adjusted withdrawal is most likely to be running low. A retiree who needs $80,000 in healthcare in their late 80s cannot tell the 4% rule to adjust. Assumption 7. The rule treats the portfolio as the only income source. For most Americans, it is not. Social Security provides meaningful monthly income. Some people have pensions, some do part-time work. The 4% rule applied to your total portfolio, without accounting for other income sources, may significantly understate your actual sustainable spending. So where does this leave you? Here is what the updated research actually says. William Bengen, again, the rule's inventor, now says that with proper diversification across more asset classes, beyond just US stocks and bonds, the real safe max is approximately 4.7%. He writes in his 2025 book that 5.25% to 5.5% seems like a reasonable conservative estimate for current retirees, depending on their situation. His view is that the original 4% was too conservative because it only looked at US stocks and bonds rather than a more diversified global portfolio. Morningstar takes the opposite view. Their 2026 State of Retirement Income Report, published December 2025, puts the safe starting withdrawal rate at 3.9% for a portfolio with 30 to 50% in stocks, assuming a 90% probability of success over 30 years. They are more cautious because of current high equity valuations and lower expected future returns. However, Morningstar also found that retirees willing to accept some variability in their annual spending can start as high as 5.7%. That last part is the key. The flexibility is the answer. The problem with the 4% rule is not the number, it is the fixed nature of it. Withdrawing a rigid inflation-adjusted dollar amount every year, regardless of market conditions, is the structural flaw that Schwab identified. Real markets are not smooth. Real retirees do not spend exactly the same inflation-adjusted amount every single year for 30 years. Real life has good years and bad years. A withdrawal strategy that acknowledges this and adapts to it performs better than one that ignores it. Here are the 3 strategies that the research supports as improvements over the rigid 4% rule for 2026 retirees. Strategy 1. The Guardrails approach. Instead of a fixed withdrawal rate, you set upper and lower guardrails. You might start at 5%, slightly higher than the classic rule. But if your portfolio drops and your withdrawal rate rises above 6% of the current portfolio value, you cut spending by 10%. If your portfolio grows and your withdrawal rate drops below 4% of the current value, you allow yourself a 10% spending increase. This approach starts higher, allows for upside in good years, and protects against catastrophic depletion in bad ones. Morningstar's research suggests dynamic spending strategies like this can support starting withdrawal rates approaching 5.7%. Strategy 2. The bucket approach. You divide your retirement savings into 3 buckets. Bucket 1 holds 1 to 2 years of living expenses in cash or very stable assets. A high-yield savings account or short-term treasuries. This is what you live from day to day. Bucket 2 holds 3 to 7 years of expenses in medium-term bonds or conservative balanced funds. This refills Bucket 1 as it depletes. Bucket 3 holds everything else in long-term growth investments, stocks, equity funds, growth assets. Because Bucket 1 insulates you from having to sell stocks in a down market, you eliminate the worst-case sequence of return scenarios. Your long-term bucket can ride out downturns without you being forced to crystallize losses by withdrawing during them. Strategy 3. The floor and upside approach. You identify your essential monthly expenses, housing, food, healthcare, utilities, and fund those from guaranteed or near-guaranteed sources. Social Security for most people covers part of this. Treasury inflation. Protected securities or a simple annuity can cover the rest. Once the essential floor is covered, everything above it, travel, gifts, home upgrades, fun, comes from the growth portfolio. You can afford to be more aggressive with the growth portion because you are not depending on it for survival. This approach is psychologically easier to manage and structurally more resilient than a single portfolio with a single withdrawal rate. So what is the right number for you specifically? The honest answer is that there is no single right number. The Santa Clara University research published in 2025 put it plainly, no fixed withdrawal rate is universally safe. Your number depends on your retirement age, your life expectancy, your portfolio construction, your other income sources, your spending flexibility, your healthcare situation, and what you actually plan to do in retirement. But here is a practical framework. Start by identifying your non-portfolio income, Social Security, any pension, any income you expect to continue earning. Subtract that from your expected monthly spending. The gap is what the portfolio needs to cover. Calculate the withdrawal rate that gap represents as a percentage of your portfolio. If that rate is below 4%, you have significant flexibility. If it is between 4% and 5%, you are in a reasonable range but should use a flexible withdrawal strategy rather than a fixed one. If it is above 5%, without flexible income sources, you need to either save more, spend less, work longer, or some combination. The 4% rule is not wrong. It was never supposed to be a permanent answer. It was a starting point. A floor. A worst-case historical calculation designed to tell you the minimum safe rate under the worst historical conditions. Bengen himself called it the safe max, the safe maximum. The financial planning industry turned a worst-case floor into a universal prescription, and that is where the problem started. The research in 2026 is telling you the same thing from multiple directions. Be flexible. Know your actual number. Build a strategy that adapts to what markets actually do, rather than one that assumes markets will cooperate with your spreadsheet. The rule gave you a starting point. Now build something better.